Mm. Is the shit working? Oh, okay. Cool. What's up? New member icons? Yeah, a couple weeks ago because they unlocked them. Good morning, everybody. Did Carl do a list of tickers? Fucking goddamn it, Carl. GME, DVN. Someone want me to look at Siemens. I thought we were going to try something else besides tickers. Like what? What do you want to do? Like an hour and a half, so. QBT and QBTS. Bull, please. Hymns. Alright, we can do a few. You guys suck. Jimmy kind of looks like dog shit. Rough. Foreign exchange arbs calm down a bit. Liquidity seems fine. Volatility's falling off. It doesn't look particularly great. Let's take a look here. So it fell back below Gamma Max. The Gamma Max and Delta Neutral both falling. Total Delta on the chain's been dropping off. Gamma's still relatively positive. Local support is still 30. A little bit more support at 28.50, 27. What was the low? 29. There's plenty of positive delta to the downside, though. Yeah, the out of the money options, like OI, has been falling off a little bit. Most of the volume still concentrated around 30. Really no significant effect from Charm. Charm's a bit rough into Friday. Some support at 28. What? I know. Maybe 30 is falling, but just as realized vol is starting to pick up, so that might keep things in place for a little bit. The IV10 is slightly cheap. A decent range for the implied move. It's like in the money vol is yeah, volatility's picking up a lot to the downside. So I would say it probably keeps dropping. Maybe a persistent sell off. I don't know over what time period, but maybe we sell off for maybe it like GME sells off for like a few days, and then catches like a bounce midweek, before the like HV10 starts to pull back again, and into like the end of the ETF FTD period, which should be by like this Wednesday, Thursday. So yeah, I would say maybe a small pullback to like 28, at most 25, and then probably like a snapback to 28, 30. And then that might be the end of the any available covering on it. Gamma falls off pretty steadily to the downside here too. Earnings on the 13th. Have they already announced them? That's next week. Vol might pick up a little bit. I don't think their earnings are gonna like beat expectations or anything. So yeah. All right. What do we got? What was next? Devian. Ah, god damn it. Pull back to 30. Actually, that's kind of interesting. A little low, though. Oh no, how did that shrink? What the fuck? Ew. God damn it. Whatever. DVM. Still kind of just looks like shit. Completely dependent on global oil and nat gas prices, which are not doing well right now. There's still a shitload of positive delta to the upside, so if it does move up, it can move up quickly. Realized vols kind of finally bottomed out. Although the realization of additional volatility could just be to the downside. Things are still pretty fucking boring across the options chain. It's probably not going to go much lower than like 2750 right now. But there is a little bit of room to keep moving down. Still a lot of in the money sold puts. Um, QUBT. It looks like the quantum stocks. It's risky. It's like shorting AI. It's an entirely sentiment driven trade because the technology doesn't actually exist. How can you tell if it's bought or sold? I'm really good at this. Yeah, I'm probably not gonna fuck with the quantum shit. If you want to short it, I mean, it's a valid short. It's just you could end up on the wrong side of literally any news release. Chewy still above GM. That's weird. Yeah, is it? Slightly. GM's also moving up a little, but Delta seems pretty elevated. Some of the positive adjusted Delta falling off on Friday. Gamma's still relatively high, but maybe starting to move up also. This might actually start turning around. Might have just gotten driven by the insane amount of gamma on the chain. I would say it's very likely at resistance. There's not much more delta to the upside. I gotta look at vol though. Might still have like another week up here. Hmm. There's really no more increases in IV to the upside. Probably very hard for it to get any higher than 47. More likely to fall back to like 43 or so. Um, is the IV30 starting to crush yet? A little bit. I mean, options are super overpriced, both on the 10 and the 30 day. So I would say that it's probably not going to stay up here much longer. This is probably a good opportunity for call selling, or spread selling. I don't know if you own the underlying call selling, but spread selling. Maybe we should build a position on it. See what it looks like. See, so something like this, where you specifically spreads are a little shitty here, right? Because you want to like spreads are insulated from implied vol, right? So yeah, we're gonna do something different today. Let's talk about how you would build a position on this. Not necessarily that it's good, just how you would how you would do. So if we went to go look at bull call spreads on Chewy, now we know there's a little bit of interest still at like 47. So if you wanted to be completely insulated from 47, you'd probably want to be selling like, ooh, it's like 47 days. Is July OPEX the 11th? No, it's the 18th. Okay. Weird. Chewy only has 3 expirations for July. Alright, so if you sold this, maybe just do June OPEX. I wonder if 19 days is enough. So your max return. Yep, this is backwards. So if you sell something like this, the drop in implied vol isn't really going to help you very much. But if you spread this out a little wider and take on additional risk, you get a little bit more benefit from the drop in implied volatility locally on a downside move. Not much, obviously. If you just sold the call, the drop in implied volatility would be far more significant. But over like 10 days, the wider the spread, the more it'll benefit from the drop in implied vol. So the wider your spreads, both bull and bear, the more sensitive to implied volatility they're going to be. And that's really the thing that I was trying to impart here. But I highly doubt any of you want to sell naked calls on Chewy, especially when it's like running up above gamma max. I wouldn't want to, but yeah, there might be a slight advantage in selling like a three wide spread versus like the 50 cent or dollar spread, where the volatility sensitivity isn't as great, because you could get out of the 3 wide sooner. So like if it were to fall back to like 43, and like down here, and find support during that period where it's finding support and volatility is lower, your profitability would be like quite a bit higher on the wider spread, versus the narrower spread where profitability at 43 is like 50-60% over the next week. The wider spread, it's like 70-80%. This is a bear call, but it doesn't matter what kind of spread you use. If it's bull spread, bear spread, debit credit, the wider the spread, the more sensitivity to implied vol. You already know this. So something you might want to look to do if you're targeting something like this, where you expect implied volatility to fall over the window. Like, I mean, there's a very good chance that like this would just not end up in the money ever. But in order to get out of the position earlier, and stay risk exposed for a shorter period of time, the profitability on a wider spread will be better if the conditions you expect are realized. So something to think about on that one. Let's go to the next. That one doesn't seem bad. little shit like that is usually, they're very high confidence. They're you're playing a mean reversion and volatility in the short term. And they're a great way of just making money, just like not a lot of money, but just like a good way of making like, income. And, at 70% on risk, significantly more income than you would get from something like, dividends or anything like that. Let's see. SMCI, Upstart, Hims. Oh, okay. Hims. We could check out Hims. What's Hims doing? Hims caught a little bit of a bounce under gamma neutral. Looks like gamma spiked on Friday. Might be some short dated positioning because Delta continued to slide off. So I'm imagining something came in. Probably all this volume on like the 60 and 57. It's quite a bit. Uh, yeah, so this might have found that low support around like 52. There's still a lot of positive delta to the downside, but 60 doesn't seem like a bad target if it can break back above gamma neutral. I would just worry that the retested GN would fail. Like there was a little turnaround in vol on the 30, and 10-day options are still a little bit overpriced. And it does look like the interest around spot is pretty flat though, with more interest further out of the money. Like under 50, there's a lot of interest, but hmm, what a fucking weird vol structure. There's nothing further out on it. I mean, that's really what's going on here. 51. Yeah, I would be worried that this rejects off of the gap fill and falls back towards delta neutral just because of the decline in delta. Like the end of the month push is nice, but was there news on it or something on Friday? Maybe that's what drove the bounce. Laid off 68 employees, 4% of its workforce to restructure and enhance team execution. Unrelated to the U.S. ban on Wegovy manufacturing. It was yesterday. Insiders sold shares, 613,000. CFO. Hmm. I don't like it when CFOs start selling their shares. Yeah, I would be. I mean, the upside range is kind of shitty right now. That could change, but I would be really cautious of the retested GN. Yeah, I don't think the upside's worth playing there. Maybe short calls. I don't know, actually. Because if it breaks out to 60, then it's going to be in positive gamma. I might just push up to gamma max. Short calls might not be that good there. Counter-Strike RAM requirements just tripled. No, they didn't. Thoughts on what? I don't know. It's just risky to try to short that trade, and like the returns aren't that great. I don't know why I'm worried your write-up is going to get erased, because that happens. Alright, what was the next one? Hymns? CCCS? This had some insider buys, and delta neutral on it's starting to move up pretty quickly. So the expiration shed some of the in the money I guess the at the money puts that were on it. Gamma neutral's still not moving up at all, which is kind of annoying. GM moved up a little bit. Skew adjusted delta rose. And the positive gamma doesn't look so great. I'd say the biggest problem here is that it's not picking up like a ton of interest to the upside. There's still like a few calls out at 1250 and 15. Maybe IV30's bottomed out. Because like the 30 and 10-day options are cheap relative to historic vol right now. But not a lot of out of the money interest coming in anywhere. Maybe out on like November 10 strikes. So the ramp up in interest on this seems to have faded pretty quick. I think I still have like 20 days or so. Uh, I'd like it to get back to 9 or 10. Get a little bit of local support. There's an inverse head and shoulders on the daily. If this picks up more volume, which it hasn't yet. I mean, I do like the bump in delta neutral, but I don't really know if that's significant. And it came on a decline in total delta. I might just bail on it. It seems like it's not going to really do anything. SMCI. Do they have earnings or anything coming up? No, they just had earnings. They fill that gap. Hold on one sec. High close 38.89. There's still a little bit of a gap to the downside on this from the post earnings rally on the 13th. Delta and Gamma are both falling off pretty quickly. But not a ton of support. There's a little bit of support at 36. Plenty of positive delta to the downside though, so it can squeeze down. God, I hate that. Yeah, so options are still overpriced in the short term. It does seem that upside interest is picking up though. So maybe this pulls back a little bit further. And then 36, and then maybe gets a bounce. So kind of for SMCI, it kind of looks like it can pull back a little bit, and then that'll probably drive an uptick in out of the money interest, which is already kind of picking up over the last 2 days on the drop, but would probably pick up a lot more if it were to retest like 36 or 34.50 down there. Oh, dear God. Okay. Upstart. Upstart's not in a very favorable rate environment right now, and it's been pretty sensitive to moves in the Fed fund rate. I would be probably cautious trying to play it. Support at 45. Breakouts above 50 would be bullish. I don't really want to write this one up because I think the risk is shitty. Interesting. Yeah, mixed interest. Not a lot of delta. It could run on like a really big move, and options on like the 30 are pretty cheap. They're very cheap on the 60 and 90. Maybe this is like a good opportunity to get like theta on this. But you have to. My only problem with that is you kind of 10-day options are overpriced. They're probably bearish. Still a little bearish in the short term. Maybe it moves down and tests 45 again. Looks like it did a little while ago. Well, I guess it could fall further to like 40. Gamma neutral slip below delta, which is usually not a good sign. Total delta fell off into the end of, or total gamma fell off into the end of the week, and delta's just been flat. Yeah, I would say if this pulled back to like VN, or at least got back under GN DN, there might be a long-term opportunity there, like to pick up leaps or something while they're massively underpriced. But I wouldn't do it here. This seems like a shitty range. All the like squeezing on this is done. It's just still squeezy because the free float is so fucking tiny. It's still only like 82 million shares. Strangle? No, I probably wouldn't do that. Why a wide strangle? Like, what's the thought process behind that? Like, the downside doesn't look great. Like, it's not liquid or anything. There's no delta there. Like, it's very likely to just keep trading at its current prices until something shifts. It could fail a little, but like, I mean, a pullback to like 45 or 42 is not probably worth buying a strangle on. I think it's just because long-term options are cheap. But then why strangle? Why not just buy leaps? Like, why not go long the uptick in vol versus trying to play the downside? It's not like they're going out of business. They have plenty of money. So I don't think you need to worry about like the bankruptcy pricing that it saw back in like 2022, 23, 23. Yeah. Unfortunately, as much as I'd love to buy Upstart at fucking $18 again. Ooh, a failed pickles pick? Yeah, if it doesn't do anything on Monday, I'm gonna close it. I think I have like $500 of total exposure, so I don't want to get burned too hard. I didn't want to go bigger on it though because the chain was still kind of illiquid. Not around spot so much. Like there's plenty of options around spot, but I didn't want to blow up the spreads. It's gonna pump on Tuesday. What? CCCS? Maybe. I'm kind of interested in the move in Delta. I've got like 20 more days or something. I might hold 2 days. We'll see. If volume's a little better tomorrow, I might hold into Tuesday. But I don't know. It's not picking up the volume I want to see. Like it's got a great setup, but no one's coming in on it, which makes me think like it's probably not worth playing. All right. Was there anything else after SMCI? What about questions about like fucking trading, like actual trading questions? You know, the ones you guys are always trying to fucking ask during Gamma Strike roundtables. Carvana? I want to short Carvana at 330 and it keeps not getting there. It's close. I don't like the Gamma Max on it still moving up really fast. Maybe I need to wait to 350. Yeah, I mean, there's still a decent amount of out of the money interest on this. Jesus Christ. Hmm. 30-day options are pretty cheap. 10-day options. Everything's like overpriced over the 10-day window. But 30, 60, 90. Uh, yeah, this still has some room to move up, which I don't like, but it does. How do I start buying puts at the bottom and calls at the top? You mean like intraday? Individual equities are going to be back on Pickles Picks? Again? Please say happy times are back again. What the fuck do you think this is? Are these not individual equities? I do these every week. I was trying to offer you guys some insight on how to analyze trades by you guys bringing me the trades, and then I give you what I see on them. You just want me to pick you stocks, right? Is that what it is? I don't want to pick you stocks anymore, Rims and Tims. Not after you bungled fucking. You bungled my baby. EPAM. You bungled it hard. You had all those sweet tendies in your pocket. And you're like, I'm gonna hold forever. Wow, Glorp, that's a really cool tool there. Which one? They're all super cool. Here's a trading question. Are any of these looking like good candidates for some put selling? Let's find some sell side plays for modest income. I went over that with Chewy. Were you not here? We literally did like a whole 30 minutes on talking about sell side and playing mean reversion and volatility with spreads. The vol tool? Yeah, vol's sick. Now it does all the things it's supposed to do. It's super sexy. Did you go for the big move up on Friday and what you were looking at to go long calls after the big drop? Well, we went. There was no more down. We hit it. We hit like a solid support, and there was a lot of put selling when we bottomed out, which is usually a good indication that you're not going to drop anymore. Obviously, as price kept going up and we regained more stable levels at like 58, 75, 70, things got more bullish. But I mean, I don't think there was anything really special about it. It was just a pretty easy bottom to define. Like even on your guys like live data, you could see the fucking out of the money vol crush on the like 58 40 like 40 test or 45 test. The 0DT IV is higher than the SPX weekly chain IV. 0DT, no, you mean monthly? Are you talking about the implied move spread? The implied move spread favors the weekly contract on the 1 day. Then that's more bullish. People are gonna be willing to sell puts relatively close to spot, or if they're going to be going long volatility on the further dated contract, and then yeah, that's flipped if it's if the spread favors the monthly contract. So the spread favors the monthly contract. Like you want a short vol on the monthly, right, to close the arbitrage between the. But like that doesn't really do a lot of damage at spot because there's not a lot of gamma on those contracts. And so, meanwhile, but it does make it super risky to sell puts on the 0 DTE within the implied move. But in the outer bounds of the implied move, it's far safer. And that varies over all the funds looking at it and different interpretations of what that range should be. But I find that it's pretty reliable that when options become mispriced, someone will step in, and they do become mispriced at the outer edges of that implied move. EPM seems like it could do a summer move. I mean, that was based on earnings and like a lot of talk about resolution of the Ukraine-Russian conflict, which is not looking like it's resolving now. Give me 1 second. I'll be right back. All right. Um, I'm back later. Give us an example of trading that. I mean, you're not going to trade vol arbitrage. So it's kind of irrelevant. What you can do is use it as, a signal of where a price is likely to find support or mean revert. In situations like Friday with the big drop and reversal, are in the money or out of the money calls better there? Well, out of the money calls are much higher risk. That's why I bought the 58.50. So I bought the 58.50 on the drop because I could just set like a fairly close stop on it, and if we didn't continue to move up, I wouldn't really take too much of a loss. But if you bought the out of the money call there, especially on like a small reversal that failed, you just get blown up. So you want your option to get in the money as fast as possible in a situation like that, because otherwise the decay on the option, especially like that late in the day, is really damaging. And if price were to slip back and fail the lower support, your option would just get destroyed. And so buying like the at the money contracts allows you to not only get in the money really quick, but immediately protect that option against additional downside. The old live data page isn't showing you accurate end of day gex though, and the end of day gex is drastically different than it was when we bounced. You've got to stop looking at the fucking old live data pages. They're bad. They're like they don't work properly at all. The there are issues there. That's why we changed them and fixed them. But you're looking at gamma that was on at spot at close. I know it's fun and like what we are going to do though, and something I did discuss with Nuke is we are probably going to, at least for a short while, start the DF and GF at market open, so they don't have that period of irrelevance at market open. So they'll be a little less accurate, but they will be more actionable in the early part of the day instead of doing the overnight trades and then having DFGF open based on those overnight trades. But while we do that and make that more actionable, we're going to work on getting overnight pricing for SPX, and that way we will be able to make those accurate during the overnight session as well. Because that's the difference that you guys are seeing in the old and the new, is that the old one started at market open, right? And so all your calcs, like, so the DFGF seem very important in the early part of the day, like the first like 15 minutes to 1 hour. And that's because the calcs were starting at open at 9:30. The current ones, you'll notice they start further from spot and then will drift towards spot as options concentration moves. And that's because these are being calculated all through the overnight session on the incoming trades. But they're being calculated on the overnight session on incoming trades at the prior close spot price, which isn't incorrect, but it does throw them a little wider and makes them a little less actionable in the early part of the day. And so the solution is, for now, we're going to start these at open so that they're, actionable to spot price at open. But what we are going to do is we are going to start calcing the overnight spot for those, and that way when market opens, everything is right where it should be. And that way everybody gets the best of both worlds. Neither. I'm not going to tell you how we're going to get it, but we're going to get it. Is Mag 7 going to get pumped this week? I don't know. Dispersion didn't look very good into the end of last week. I know we bounced into close, but that like end of the month bounce isn't generally followed by continuations, and it wasn't a very strong bounce. It didn't bring us up to any of the significant levels that we needed to cross. Hold on, let me fucking get a picture of this for you guys for Pickles picks. Let's figure that out. But we can take a look at, is JFresh hopping on? I don't know. Oh, come on. How am I supposed to feed my hunger from minutia? Well, the way we have to do it is going to be proprietary, and we don't want other people figuring out how not to pay for CME. So it's a big advantage. I just need surf chart. Shh, don't say that on stream. Why? There's always information somewhere else. If you're only missing one variable, it can be solved. Oh, JFresh wants everyone to know that he's in on the Trump credible until next Tuesday trade. All right. Let's take a look at some of the end of day stuff from last week. Yields stayed relatively flat over the entirety of the week, with them spiking a bit into like Thursday. But then falling over the rest of the week. So now we're back to like where we were almost at OPEX, except the 20 and 30 year are still a bit higher. Dollar's kind of flattened out in its current range, right around 100. It is starting to form like a lower high, but it looks weak. So we might see a little bit more of a pullback in the dollar, in which case we could see yields move up again. The 20 year is still like 4.9. 10 years slightly below 4.4. But most of the activity I think there is on the 10 year. Correlation really hasn't pulled back to where it was in the initial phases of the pump. Um, and it seemed like it was a hard time keeping the dispersion trade together at these lower levels. The demand for long vol was still relatively high. And then, more recently with NVIDIA earnings, also correlation started to break down following that as well. Now, remember, as we move into this week and next, we're going to start to hit the blackout window for share buybacks. So those positive flows are going to erode over the next 2 weeks, and then they're going to start moving negative after that. So we're already past the peak in the share buyback window, and so from here on out, we should mostly see share buyback flows start to decline. What was really interesting about buybacks, and I did mention this in Pickles Picks, so I don't know if you guys caught it, was that the amounts being promised were not the amounts being bought. So I think over the last several years, right now, like actual buybacks are significantly lower than the increases in buybacks being announced at earnings. And that's an interesting tactic, and that keeps share prices, artificially higher for longer. But if you come out and say you're buying back 50 million or 100 million or 500 million in stock, but then you actually only buy back 10, over enough period of time, like, the initial pump from you promising those buybacks is going to fade on the lack of realization of those buybacks. And so that's kind of a dynamic that seems to be everywhere in the S&P right now. And something probably people should be taking
Someone
note
put their
of.
pickle in my jar. I'm seeing more and more vanilla YT influencers and FinTwit talking about yields in the carry trade
I'm
and
seeing more and
impending
more
doom.
vanilla
Not sure
YouTube
what to make of what
influencers and
seems
FinTwit talking
increasingly
about
like a
yields and the carry
push-on pull
trade and the
moment.
impending doom.
5.
Not sure what to make of it. What seems increasingly like a shoe shine boy moment. I don't know if I've ever heard that phrase before. Oh, okay. I know what you're referring to. Yeah, it could be. I mean, the problem is no one really knows one way or the other. I know what he's talking about now. I didn't realize people were trying to make a theory of that. Yeah, I mean, I feel like I would say that we're past that. I think 2024, early 2025 was really that moment of extreme exuberance. I think there's a lot more fear now. Maybe not on the retail side, but that's because people are afraid. So like the buyers that are coming in are buying in because they're afraid they're going to miss out on the potential and the upside, and they see a discount and they want to take advantage of it. And that's why, largely over the last few weeks we've seen retail flows explode, but we're not seeing a lot of institutional positioning that would indicate any kind of long-term bullishness. And that's twofold. One, order routing via retail exchanges from major institutions. There's generally something reserved for funds that are higher risk. And then also, retail is just less informed. There is an inevitable consequence of tariffs being implemented, no matter what. For the period that they were in force, there were breakdowns in supply chains. There was rerouting of supply chains. That damage can't be absolved by pausing tariffs or delaying them or pulling them back. Even if the Trump administration decides to obey the orders of the International Trade Court and it doesn't get overturned in appeals and doesn't get overturned in the Supreme Court and they have to pay restitutions to those businesses, those changes to the supply lines will still have happened, right? So no matter how much money you pump into the system, no matter how much goodwill you extend, you can't fix what's already happened. Businesses had to prepare for tariffs. They had to realign their supply chains for tariffs. And all of that planning and strategy that was implemented in advance of the tariffs, that doesn't just go away overnight. And so the damage done from that is done. How it's going to play out, we don't know yet. But I mean, I think the fact that we're 4 weeks into the strongest rally since end of 2023, and we haven't really seen CTAs pick up positioning, they're at like zero, basically. They're net, like flat. Prime books are still net short. Hedge funds are net short. We don't see like a lot of demand coming in from, pension funds and mutual funds. Like all the big players are just waiting. They're biding their time. And many of them are still net short. And they're in the pain trade a little bit, but they're not closing, right? They're not taking the hit. So I would say that, the macro thesis broadly and the people who move the market are sitting on the sidelines right now. They're not doing a lot, and that's one of the reasons that we have like some stagnation in yields, and we're not seeing yields really move either way. And there's big things that'll break, and we'll find out. Actual trade deals on paper take years, and so we're not going to get that. That's always going to be kind of something that the market clings to. That's opaque enough that it can drive FOMO and interest, but it's never going to be something that we can hold in our hand and look at. It's not going to have any physical representation for a long time. Kind of like the Fed rate cuts back in 2023, if we're thinking about it from like a sentiment point of view. Like the market simply needed the rate cuts promised to it, even though we only realized like an eighth of the expected rate cuts, right? The market just needed the promise that that would happen because the market's trying to look forward. And right now, the market's rallied a lot on the promise that these trade deals will happen, but we're very, very far from signing anything or even drafting the initial phases of those agreements. And we already have issues. Trump's lashed out at China already. China's lashed out at Trump already. That the steps they are taking are violating the initial conversation that they had, and that only pushes that trade deal further out. In the meantime, those reciprocal tariffs, which are blocked right now, are still on a delay. And so, when we hit that period, and I think it's in July, is going to be when the reciprocal tariffs come back into effect. We're going to have to see what Trump does because we don't fucking know. I mean, the court can make an order, but they can't enforce the order. That's up to the executive branch. And if the executive branch isn't going to enforce a court order upon itself, then those tariffs that everyone thinks are gone could just come right back. And I think that's why a lot of big institutions would rather sit in the pain trade, eat the near-term losses, rather than take the risk of going long. Yeah, he's lashing out on EU as well. There's really no information there at all. It could be a gigantic bull trap, but everything could go the other way as well. Right, Trump could, yield and give up on the tariff idea and move on to something else, or his next way to grift businesses without setting up his own personal, you know, cronyism driven economy. But we don't know, that's the problem. It's up to the completely arbitrary decision of very few and arguably extraordinarily uninformed people. So when basically we're just waiting. And right now, or at least over the last couple of weeks, a lot of that waiting seems to be roughly at the same price. And I know everyone's like, ah, shit's so bullish or bearish. No, we're a good fucking 4 weeks into just trading flat between like 5,800 and 5,900. No one wants to lever up. No one wants to drop the leverage they already have. So we're just kind of going up and down. We wanted a random rate generator and got a random tariff generator. We kind of got a random rate generator too. It's just not as volatile as I would like it to be. Once base commodities increase their prices, they will not lower them back to where they are. Yeah, they will. I mean, commodities will always be somewhat driven by demands. Um, Remember, and we've talked about this a lot in the past, but not all you guys were here back then, so I'll reiterate it. In an environment where sellers do not have to compete for buyers, they will never drop prices. But that's not something that lasts forever. And we can and very likely will see prices decline at some point in the future. And we could see them decline rapidly enough that companies that are not very flexible in their supply chains or their pricing can fail. I mean, this is what kills monopolies. It's almost never the actual government. The government does very little to kill monopolies. All of our antitrust actions are usually bullshit, and especially now with multi-trillion-dollar companies paying, the $10 billion in fines, and they just keep doing what they're doing. The risk to those companies is that the economy gets bad enough that people simply won't pay, for their advertising in tech, and then tech starts laying off people and their capexes drop and decline. And that means, other companies that are relying on the capex output of like the big tech companies start to fail. And that breaks down throughout the system. And that's the opportunity when competitors that are more nimble and are able to, price in even negative margins, are able to seize market share, and they become relevant. And that's what tech did in 2000, the period following 2000 to 2008, and the period following 2011 till now. Was tech was the one that was flexible on pricing, and they could come in and seize market share and create markets. And so they benefited from that growth. EU signaled retaliation, albeit reluctantly. Yeah, I mean, I I don't think they're that reluctant to retaliate. I think they're just trying to bide their time until it just goes away. But it may not, right? In which case, I think EU is not going to react positively to reciprocal tariffs with the US. Anyway, let's take a look at options macro real quick, to get an idea of what's been going on kind of under the surface here. So back on like May 13th, we saw the peak of put leverage. It dropped off, got a slightly lower peak, and then another lower peak this last Thursday, that which also fell into Friday. We've seen almost no changes in call leverage. The peak of that put leverage, though, is getting slightly closer to the money, between like 4.49 and 4.1. So 4.1, 4.9% below spot is where most of that put leverage is. And we're still not seeing any notice. This is very important. The lack of call leverage to the upside of spot means no one's really buying, anything outside of like 1.6% to the upside of where spot is right now. And then call leverage just falls off a cliff after that. Meanwhile, we're stuck between like a range where, delta on calls is very sensitive to move increases in price, but delta on puts is very sensitive to decreases in price. And so basically what's happening is as we move up, we move up very quickly because call delta is increasing rapidly. But then, when we get a rejection, we also move down very quickly because put delta is increasing rapidly. And that's really what we've seen, when we look here. over the last couple of weeks is, we get these sharp moves up, and then they sell off, and then we get another sharp move up, and it sells off. It's yeah, no, I don't think we're getting any quants today. JFresh is doing stuff with his kids, and Dork's unavailable, so just me. Um, and so we're kind of just realizing the effect of that positioning over and over again. But positioning isn't getting more bullish to the upside, and it's not getting significantly more bearish to the downside. And so, I mean, this is kind of where we're stuck. I would say that, like, put interest on QQQ, and maybe like IWM is increasing. Like IWM is a bit more bearish, but that's not really going to be a leading indicator of what happens with tech. Um, and so, and a lot of the, like, the delta isn't until like 30 days out. So we're in a, like, really low delta gamma driven environment that's kind of range bound. And I would say that this probably isn't going to change unless we get a significant change in macro. Great value quants today only. I want my Kroger. Dork in a bread coma? That's what I assume. He's too busy playing with his bulls. Um, uh, yeah, this coming OPEX has a pretty decent amount of delta dropping off on the SPX chain. Hold on, we got it. Pretty decent amount of delta dropping off in the SPX chain, 1.29 trillion, and then 3.19 billion on Gamma, and then on SPXW, we really don't have a lot of Gamma over the next several days, 2 weeks, and so this should open up more volatility. There's, with so little Gamma around spot, and also negative Gamma into the back half of this week coming up. We could see maybe like a move back down to like gamma neutral on the monthly, or back down to like that sub 5800 range. Um, I think opening up room to the downside is going to just encourage a move to the downside, especially with so little gamma supporting the current spot price. So that's something I'd probably want to keep an eye on. And also, if you look out at the ball smile, most of the IV and demand is a little bit out of the money. Not very far, but a little bit. Like increases in IV seem to be showing that demand is slightly to the downside. The smirk is skewed a little bit more to the downside. And we do have probably some important data this week, given the term structure on vol here. I would say options on the 30-day and the 10-day are pretty cheap. Our implied moves are dropping really rapidly. So there is an opportunity for long vol to come in, IV to push up, and things to reprice a little bit, because I mean right now 30-day options on SPXW are extremely cheap. Um, Very expensive out on the 60, but on the 10 they're pretty flat. On the 30 they're very cheap. Um, so yeah, I think there's a little bit of like an edge to the Bears, but we'll see how that develops. Well, probably tonight. If we pull right back down under the collar tonight, we're probably not going to have a very fun day tomorrow, or maybe even through the rest of this week, with so little gamma on the chain to support spot price. It was just the baby collar, and yeah, we know where it rolled to, but it was like 61.75, 54 something, and 46 something. But it's just the little dinky baby collar. It's like 5,000 contracts. It's not very relevant. Well, remember, the only problem is as we fall and vol moves up, it's very likely that we do find people willing to sell volatility. I mean, I would say that right now, people are probably going to sell vol at spot on like the 10-day if it exceeds like 18-20. We did get like a little uptick in VX into the end of last week. I think it ended up closing around 220. Like we pulled back a little bit into close on Friday. And like the bear steepener picked up a little bit Friday. So like Friday, even though we bounced, it really wasn't all that bullish. Correlation still staying really high. So like we are getting a trend of vol shorting coming in, but I think most of it much lower than spot. Like the really durable vol short positioning, which isn't even that durable, is mostly down here, like sub 58.50. Um, so they want to protect that because if we go back and we look at the if we go back and look at that leverage where all that put leverage is, right? It really starts to climb below spot. Even when you get like you know zero point 0.8 below where we closed Friday, put leverage moves up uh, like zero point 0.4, and then like 2.4% below spot. It's up at 10. You know, um, and then right below that, like 4.1%, the majority of the put leverage starts to fall in the money. And if you look at like that since last OPEX, right? Sorry, hold on. So if we look at like the 16th till now, it really hasn't changed much, but it has shifted slightly higher. All right. So back then, the peak of short, like the short puts or put leverage was, around 6.5% below spot. And now the peak is, 4.9, 4.1% below spot. And the more that short vol positioning decays, the closer it's going to get to spot, and the more at risk it is on a downside move, right? Because we've talked about this. They're collapsing when they do the dispersion trade. They're collapsing the price discrepancy, and as that put leverage moves closer and closer to spot, it's a better and better indication that the discrepancy in pricing is closing, right? And there's, once you've closed the arbitrage in the trade, there's really no reason to stay in that trade any longer. And there's no reason, and if that put leverage falls off, there's no reason to be in that trade any longer. Correlation's going to move up really, really quick, and you're gonna see volatility rise on indexes. So I would say if I had to make a prediction for this week, I didn't do too bad last week. I was like $20 off. Well, I was just off most of the week. But if I'd done that, if I'd only been a few dollars higher, it would have been spot on. um, just wasn't prepared for the overnight rally on the weekend news when I wrote this up. But I think a lot of that came in while I was writing Pickle's picks too, with the China tariffs and shit. But this week, I mean, we still have similar weakness. We have a lower high out here on the daily. So I would say probably this week we're gonna get a pullback towards that 58.37 level, maybe even 57.73, and then possibly a bounce into the end of the week again. Although I think with the negative gamma into the end of the week, we might just keep falling. This week we also have, let's see, we have ISM manufacturing, which is going to be super important, and that's right out of the gate tomorrow morning. I think we have, yeah, labor data all throughout the week, and we have ISM services on Wednesday. So we're getting both ISM reports, which are very important not only for CPI but also for GDP, which came in not great on Friday, by the way. GDP was not where it was expected to be. There's still one more revision, which the market will probably wait out, especially because the two revisions are so far apart. But it was definitely a bigger pullback in corporate profits than we've seen in a long time. And yeah, not that great of a print. And then I think we have an ECB rate decision next week, German balance of trade, and then we've got, JOLTS, non-farm, unemployment, all of that shit. So that'll also probably be important, and a lot of that'll, maybe act as a stabilizer. But I think if we see ISM services fall much more, shit's gonna get really ugly. And ISM manufacturing is really not predicted to do much better either. And so we're starting to get to the points where we should feel like some more pricing shocks. I think we saw a little bump in PCE on Friday. JPOW speaking Monday. Okay. I don't know what time that's happening, but it's good to know. So tomorrow I'll probably be fairly flat then, or at least somewhat range bound. Powell speaks at 1 o'clock tomorrow. I don't think he's gonna add anything to the commentary we already have, so I'd be surprised if it led to anything interesting or even important. But I'll try to, let's see. Stay around here tomorrow. Friday. Yeah, I would say 73 is possible. All right. So, yeah, I'll do that for this week. Dirk and JFresh can make their own when they feel up to it. Where did the collar roll to? It was like 61.75 or some shit. It doesn't matter. It's not the quarterly collar. It's just the little tiny one, the like 5,000 contract one. Any thoughts on new and the steel tariffs? No, not really. I mean, I think Trump's just raising tariffs where he can because he feels emasculated. All right. Anyway, that's what I got. So I hope you guys enjoy the rest of your day, and I'll see you all tomorrow. Pickles Picks will be out tonight, so keep your eyes open for that. And I hope you guys have a great rest of your weekend. I will post the write up for the tickers in Pickles Picks right now. Catch you guys later. Peace.